Friday, September 27th, 2019, Maneco 64, home of alternative economics and contrarian views. So this morning I want to talk about what's happening in the repo market. I've spoken about it quite a few times in the last couple of weeks, made a few videos last week about it. I want to give you an update. To me, it feels like 2007, 2008, maybe more 2007, when the subprime story was evolving and very few people even knew what subprime mortgages were. And it seems to be the same thing with the repo. Of course, very few people know what the repo market is. Not only the general public, but I would even argue on Wall Street, very few people know about it. It's a very specialist market. I knew about it because I've worked in the markets. And when I started out in London in the early 90s, I did work in the bond, in the treasury market. And I had a colleague who used to do repos, very, very arcane section of the market, but very important. Many people have talked about how it's the plumbing for Wall Street, where institutions, banks, insurance companies, brokers, hedge funds, or any other big financial institution, that's how they fund their day-to-day operations, by lending out risk-free treasuries or agency bonds that are backed by the government for cash, right? And they do that, they roll it overnight to keep their funding. And the problem with Wall Street and the financial system, that hasn't been fixed since the collapse of 2008, and I've spoken about this many times. They have not reformed the system. They bailed out, of course, the bad actors from that period, the major Wall Street banks, and by bailing them out, they bailed out a lot of other people indirectly, and they've kept their bad habits. Of course, there has been some reform, but not reform that's been, how can I say, substantial to change the way these people act. And what they do is that they continue the leverage. What's leverage? Well, they borrow a lot to try to make money very quickly. The other thing that doesn't help financial institutions is the fact that interest rates have been in a bear market, well, since 1981, so about 38 years, and the lower interest rates go, the thinner the margins for banks become, for lending institutions, because they borrow, let's say, at zero from the Fed, or a little more, or even negative from the ECB, but they can only lend at a very low rate. So what they do is they leverage to try to cover their margins, because they employ thousands of people, these banks. They have a lot of overheads. They like spending a lot of money, right? You look at the PGA Tour, the golf tour, they sponsor a lot of events, right? I remember when RBS collapsed, in the financial crisis of 2008, they used to be the biggest sponsor of sports events, right? And that's gone out the window. The same thing now. I bet you a lot of the money in sports is because of this, you see. I'm not going to go into that, but you get the idea. So I think this could be the crack that gets bigger. And oh yeah, and I'd like to say before I go on, I'm going to look at the markets at the end again. People seem to prefer that. So I'll continue with the repo. I've been reading quite a bit of articles about what's happening in the repo market this week. I haven't spoken about it yet because I wanted to make, to have an idea what's going on. I read Keith Weiner from Monetary Metals, who's clever guy. I've read other people, and they all seem to have different opinions. One thing Keith Weiner said that's very interesting is that there are regulations that make banks keep more cash. So that could be one of the reasons why the repo market is, how can I say, in trouble. But it seems to be dragging on and on. When it first came out a couple weeks ago, the problem in the repo market, when the overnight rate went up to 10%, it was said it was because tax liabilities at the middle of the month. But here we are at the 27th. Now they're saying that is end of the quarter problems, but the Fed, they've extended their repo, overnight repo operation for every day until October 10th. So what's going on there, right? So one thing I've come to the conclusion, reading a lot of stuff is about the repo from specialists, is that no one really seems to know what's going on, not even the Federal Reserve. There was an article about the New York Fed President Williams on Zero Hedge, and Zero Hedge basically took him to pieces and said he doesn't even know what's going on. And the New York Fed, of course, is the branch of the Federal Reserve that runs the open market operations, the New York Fed. Very important Federal Reserve Bank, of course, owned by the private banks. We all know that the Federal Reserve is a hybrid. It's a private company, but with powers of a government agency, which is the worst kind of institution, of course. But they seem to be flying blind. And why is that? The repo market has been around for decades. I think it's because of what the Fed has done since '08 by increasing their balance sheet astronomically from 800 billion before the crisis to over 4 trillion just before they started unwinding it. They've stopped unwinding it now because there's trouble, right? They can't go back to normal. But yeah, what does that mean, increasing their balance sheet? Well, it means that they've just created money out of thin air to keep the system going. And the problem is now the banks have become so addicted to easy credit. Interest rates are getting lower and lower, so they're doing riskier and riskier things. So that's what I would say about the repo market right now, that it's a problem. We don't know what it is exactly. I think it's ongoing, of course. And I just want to look at the latest article I saw from Zero Hedge, because the Fed has even been increasing the sizes of the overnight repo, and now they're doing term repos. They've increased the size of those. Term repo is just a repo for about 2 weeks instead of 1 day or overnight. And what is a repo? I'll refresh again because some people didn't watch all my videos. It's basically a repurchase agreement. To explain it in an easy fashion, let's say you need $1 million for 1 day. Don't know what for. So what you do, you sell me your house for $1 million, right? So I buy it for $1 million for 1 day, and I sell it back to you the next day, and you give me the cash back for $1 million and $1,000. So I make $1,000 in a day there. So I make that $1,000 in a day, right? And you get your house back, and I get my cash back, right? So that's what a repo is. But they do that not with houses, but with treasury securities, with bonds that are supposed to be risk-free, right? Agency bonds. So now to this latest article. This was from yesterday morning from Zero Hedge. We need to keep an eye on it this morning as well, US time. Second term repo oversubscribed as funding shortage keeps getting worse. Update, step away from the panic button at least until tomorrow, moments after the Fed announced that its second expended $60 billion term repo came in oversubscribed, the results of the overnight repo were also announced, and they suggested that while the funding shortage is getting worse on a quarter-end basis, which is what the term repos are supposed to alleviate, it reported that its largest overnight repo operation, which yesterday was expanded from 75 billion to 100 billion, so they've expanded that to 100 billion, only saw interest for just over half of its size with 50.1 billion. So yeah, the overnight kind of eased off yesterday, but the term repo, how can I say, was oversubscribed. So a lot of uncertainty still. We need to keep an eye on this. I know the general markets are not really being impacted by this right now, but I can tell you it's very important. If Wall Street can't fund itself, how's the rest of the economy going to be funded? Because the funding, the heart of the funding or credit market comes through Wall Street. It pumps all the credit into the economy, into the other smaller banks everywhere around the United States and the world, I would say. So we need to keep a very close eye on this. So this is what is really interesting as well, that he says here, the Tyler Durden from Zero Hedge. Overnight, we cited two icons in rates repo business, both of whom confirmed that contrary to what so-called self-professed Twitter experts claim, what is going on in the repo market is bad and getting worse and problematic, and more problematic is that nobody knows what is causing it. As I said, the first one was Bank of Montreal's rates guru, Ian Lingen, who had this to say: as we approach quarter end, it's intuitive that funding markets are attracting heightened attention after last week's repo fiasco. One thing has become clear, however, and that is that the Fed is willing to provide significant amounts of liquidity to primary dealers to alleviate as much stress as possible. Well, primary dealers, by the way, are just the big Wall Street banks, big Wall Street brokers, right? You can Google a list of Federal Reserve primary dealers and you find them. There are even foreign banks in that list. So yeah, the US taxpayer is funding foreign banks through the Fed. By upsizing injections to 250 billion or more, assuming overnight remains at 100 billion through October 1st, and the terms are 30, 60, and 60 billion. Terms are the 2-week repos, respectively. The fact that we are discussing $250 billion is telling as to the depth of the constraint in repo. So this is a repo guru saying this. There's another guy here, the second one that they mentioned from Curvature Securities, repo wizard Scott Skirm, who was even more laconic. Zero Hedge says, it's great that the Fed is pumping liquidity into the system. However, why were the existing operations insufficient? As of today, the Fed has injected 105 billion in liquidity into the repo market, but rates were still stubbornly high. Whatever changed last week to cause the funding spikes is clearly still a problem. So whatever, he doesn't even know what it is, right? So that's the repo market there. So with that, we'll go look at the markets this morning, and I want to show you a chart of the Dow and why I think we're at another top. We've had several tops in the last almost 2 years, and I think we're forming a major top. When it's all gonna implode or collapse massively, I don't know, but I think we are at a major juncture. So it's 8:45 a.m. I'm a little later today. The spot gold price is at $14.99.20, down about $5. The range has been $14.96 to $15.07 in gold. I still have a key support, of course, at $14.83. That's a very long-term retracement level that I've looked at, and it happens to be also the lows we've seen since we made a top at 1555. It's made a double bottom around that level, so that's a key level there. Silver is being sold off today as well. It's down 1.4%. It's at $17.56. Low has been $17.42. Key support there is around $17.30. The Dow, and I'll look at the chart right now as well. Dow hasn't, in the stock market, they haven't really had a great week. It's at 26,928, up 27. So yesterday the markets were off again. The Dow was up, down about 80. And I'll quickly show you this Dow chart. Especially with October coming up. That's the other thing I wanted to say. October is known to not be a good season for the stock market. We've had the 1929 crash was October 24th. It started then. We had the crash of 87 where the stock market lost over 20% in one day. That was in October. And also the financial crisis of 07-08. On October 3rd, Congress passed the Emergency Economic Stabilization Act of 08. On September 29th, of course, the House rejected TARP, $700 billion, the first time it came out. The Dow dropped 770 points. So yeah, this is not a great season. So let's look at the chart here. As I said, and this is, I'm going to show you the daily chart. First, you can see that we topped on the September, you can see that we topped on the 12th of September, and it's been coming down ever since. That's the daily chart, and you can see that we had a major top in January of last year. Yes, we've broken through that high a few times, but it doesn't really have much momentum. Weekly chart gives you a better idea of where we are. We're not at a bottom in the stock market, as you can see by this chart. And that's why I think it's concerning. They could keep it up here for longer, but I think we're getting nearer and nearer to a critical juncture. Is it the repo market that's going to cause all this? Who knows? But we need to keep an eye on it. To the other indices, S&P up 3, 2981. NASDAQ 100 future down 5, 77.68. Sterling continued to come off. We hit 125 earlier this week, I think, or late last week. We have been below 120. I think we're going for another leg down in sterling or the British pound. Right now it's down another 1/3% at 122.78. The euro is unchanged, 109.21. Dollar unchanged, 107.81 against the yen. The dollar is down slightly against the Chinese yuan at 711.92. WTI crude oil, 56.20. Not moving that much. Brent the same, down about 0.5%, 61.48. 10-year yield is up about 1 basis point, just under 170. The 2 years at 166. So the curve is still upward sloping there by 4 basis points. I would be cautious of buying into what anyone says about what's going on in the repo market. On the mainstream, by central bankers, by economists. As you saw, it seems like nobody really knows what's going on, and that's not a good thing. It just goes to show that the central bankers are flying blind. And that's what Julian Tett of the FT said in an article about the repo, I think earlier in the week that I talked about. So yeah, the central bankers are flying blind right now, and that's not a good thing. And that's why you want to try to be out of this system as much as possible. And how do you do that? Well, by having tangible assets outside the system, be they real estate assets unencumbered, be it monetary assets like precious metals, physical gold and silver, and other things. Fine art, if you can afford it, fine wine, all those things are tangible and not paper. If you enjoyed this video, Make sure you hit the like button, subscribe to the channel if you haven't yet, and you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.